Hello. Let's learn about additional paid-in capital, what it is, formula, and examples. Additional paid-in capital is an accounting term referring to money an investor pays above and beyond the par value price of a stock. This occurs when an investor buys newly issued shares directly from a company during its initial public offering, IPO, stage. It is itemized under the shareholder equity, SE, section of a balance sheet, offering a profit opportunity for companies as it results in them receiving excess cash from stockholders. During its IPO, a firm is entitled to set any price for its stock that it sees fit. Investors may elect to pay any amount above the declared par value of a share price, which generates the APIC. This is also known as contributed surplus. For example, if XYZ Widget Company issues 1 million shares of stock with a par value of $1 per share and investors bid on shares for $2, $4, and $10 above the par value, the resulting APIC is $10 million. APIC is generally booked in the SE section of the balance sheet. The total cash generated by the IPO is recorded as a debit in the assets section, while common stock and APIC are recorded as credits in the equity section of the balance sheet. Par value signifies the value a company assigns to stock at the time of its IPO, before there is even a market for the security. Issuers traditionally set stock par values deliberately low to avoid any potential legal liability if the stock dips below its par value. Market value is the actual price a financial instrument is worth at any given time, determined by the stock market based on company performance and investor sentiment. Paid-in capital includes the par value of both common and preferred stock plus any amount paid in excess, while additional paid-in capital includes only the amount paid in excess of the par value of stock issued during a company's IPO. Both of these items are included in the SE section of the balance sheet. APIC provides a layer of defense against potential losses and does not raise the fixed cost of the company. After issuing stock to shareholders, the company is free to use the funds generated any way it chooses, whether that means paying off loans, purchasing assets, or any other beneficial action. APIC is a great way for companies to generate cash without having to give any collateral in return, and purchasing shares at a company's IPO can be incredibly profitable for some investors. APIC is recorded under the equity section of a company's balance sheet as a credit. The total cash generated from APIC is classified as a debit in the assets section of the balance sheet. Here are 3 key takeaways. 1. Additional paid-in capital, APIC, is the difference between the par value of a stock and the price that investors actually pay for it. 2. APIC is usually booked as shareholders' equity on the balance sheet. However, the cash generated from the sale of stock, both the par value and APIC, is recorded in the assets section of the balance sheet. 3. APIC is a great way for companies to generate cash without having to give any collateral in return. Hope this would help. Thanks for watching.